let's look at the transmission and limitations of monetary policy. First off, what is money? Right? The figure here illustrates the composition of M1, and M1 include checking deposit, currency, and traveler's checks. And M2 would include the money market, mutual funds, and other deposits, as well as saving deposits. And we can see that both the M1 and M2 have been increasing. And this connects to the idea that traditionally, when we think of money, we look at the currency note, checking deposit, savings deposit, and all this. But with the innovation in the banking industry, we have access to spending beyond this so-called old-fashioned money, because we can spend money in terms of using our credit card. We can sell our stocks quite easily nowadays, or exchange traded funds, and we sell it and we get money in a couple of days' time, and we can spend it. Right. So the idea of money strictly defined by just M1 and M2 have loosened significantly. Money supply is very useful when we want to understand the transmission of monetary policy. This is a very important equation. MV equals to PT equals to nominal GDP. This means that money supply multiplied by velocity equals to price times transaction equals to nominal GDP. The textbook has made it very simple. The idea is that if the central bank wish to inflate the economy, all they have to do is to lower interest rate and increase money supply. And if they want to deflate the economy to fight against inflation, then all they have to do is to raise interest rate, reduce the money supply. But the real world is more complicated than the textbook. Let's examine this equation again. Money supply. Well, if we increase money supply, then according to this formula, we should expect nominal GDP to go up. Fair enough. But the challenge is, what happened to this part of the equation, the price and transaction? Because when the central bank increased money supply, it create more economic activity, more transaction, more employment. However, in certain situations, increasing the money supply do not lead to more transaction, but they lead to more price increases, inflation. Right? This is where the credibility of the central bank is very important. In a country where the central bank has strong credibility against fighting inflation, then chances is that when money supply increase, then this will lead to more transaction. For countries where the central bank has no credibility, then whenever the people hear that the central bank is increasing money supply, cutting rates, people rush out to buy goods and to hoard them, and prices goes up, and inflation start to turn into a vicious cycle. How does the central bank create money? How does the central bank increase money supply? Let's take a very simple example here. This is the open market purchase, where the Federal Reserve Bank of New York would transact with, say, the Bank of America. If the Federal Reserve were to buy $100 million from Bank of America, then what the Federal Reserve would do would be to bring in the securities and market as their asset, and they would create a corresponding $100 million of liability, that is money that they owe to the Bank of America. And on the Bank of America balance sheet, they have given up $100 million worth of securities, and now they have $100 million worth of reserves as asset. Right? So this is a very simple idea on how central bank create money, how uh, they increase the money supply. If you use the Federal Reserve Economic Database website, FRED, Federal Reserve Economic Database, you can easily find the M2 numbers. And as you can see here, in the year 2020, because of the COVID crisis, money supply had increased sharply. Let's develop this further. We had looked at how when money supply is increased, it could either lead to increase in transaction or increase in inflation. At, a, at that time, just like in all textbook, we assume that velocity is unchanged. It is stable. Let's cut here. The light has gone out. Oh no, the light is fine. Okay, let's continue. All right. We had 3, 2, 1. 3, 2, 1. We had assumed that velocity is stable. Is it really stable? Well, if we increase my supply and velocity is falling, then it would offset, the falling velocity would offset the increase in money supply. What if velocity is falling rapidly and is so, the velocity is falling so fast that whatever money supply that's coming in is insufficient? Then the economy would contract. And this is what is often referred to as pushing on a string. Again, you can go to FRED and look for the data, the chart on velocity of M2 money stock. What do you see? You see a steady drop. Right? So what is velocity of money? Velocity of money can be thought of as a simple idea, how often you open up your wallet to spend money or to receive income. Right? So this tells us that velocity is falling, economic activity is shrinking, right? Despite the Fed increasing money supply. The textbook has often talked about how higher money supply create inflation. But other research have shown that it is money velocity that has a better correlation with the inflation rate. So here you have money velocity year on year, change in money supply, money velocity, and here you have the U.S. core CPI year on year. You see a very nice visual correlation here. So the idea that too much money chasing too few goods, right, might be replaced by faster money turnover chasing too few goods. Right? So we have to bear in mind that when we look at MV equals PT, while M is important, velocity, as indicated by this research, can be just as important, if not more important. Nonetheless, money supply numbers are still very useful. And here you see this very nice correlation between the global real M1 and the MSCI World Total Return. You see this very nice correlation here. Essentially, the idea is don't fight the printing press. Okay? If the central banks are increasing money supply rapidly, this money got to go somewhere, and chances is that this money would end up in the stock market. This is a very useful diagram because it shows the connection between the official interest rate, say the Fed funds rate, and how it connect to expectation, money market rates, and exchange rate. Right? You'll see that when the Fed changed the Fed funds rate, it immediately affect the money market rate, and that affects the money and credit, asset prices, bank rates, and this in turn affect the supply and demand of goods and labor, affect the domestic price and import prices, right, through the exchange rate, and this affect the overall inflation rate. However, there are factors that's outside the control of the central bank, outside the domestic economy, because there are shocks outside the control of the central bank. For example, change in risk premium, and this would refer to the equity market premium, corporate bond spread, and the yield curve. And it could also, the shock can also come from changes in bank capital, because the central bank behave in a very strange manner. When we have a recession, one part of the central bank would want to increase money supply, to encourage more loans and more activities, right, to prevent the recession from getting worse. However, there's another part of the central bank, specifically the bank examiners, that would want to control the bank's loan, to want to make sure that the banks do not give out loans too generously and end up filing for bankruptcy. Right? The transmission of monetary policy also involve inflation targeting. The argument for inflation targeting is that it would make it clear that the Fed cannot affect real GDP in the long run. So if it cannot control GDP, maybe it should just look at inflation and keep inflation stable, right? And if inflation is stable, then the economy will take care of itself. Easier for firms and households to form expectation of future inflation. So if the Fed tells us that they are targeting a 2% inflation rate, then hopefully the firms and household would believe that looking forward, inflation is going to be 2%. There's no need to rush to hoard goods, right, in case inflation may flare up. It also promote Fed accountability. So this is like a key performance indicator for the Fed, right? So we can judge whether they have done a good job or not. However, the argument against this is that it reduces the Fed's flexibility to address and accountability for other policy goals, namely economic growth. If the Fed were to be too fixated with fighting inflation, if this is the way they are judged, then uh, they may not want to lean towards stimulating the economy for fear that inflation may flare up. But at a time when the economy needs a lot of help from the Federal Reserve, that's when the Federal Reserve should not just focus on inflation. And they assume that the Federal Reserve can correctly forecast inflation rate. Given whatever research that we have seen so far, uh, trying to forecast inflation is very difficult, even for the Federal Reserve. In terms of the inflation data, what do they look at? Right? Although we always often talk about CPI, but the CPI numbers are too volatile and it often overstates inflation. If you look at this green line here, you see that is very, very volatile. Okay? Compared to core CPI, right? Core CPI means CPI excluding food and energy. So the Fed had used the PCE, Personal Consumption Expenditure Index, right, which is a very broad index similar to the GDP deflator. As you can see from this chart here, right, the core PCE deflator has slightly less volatility compared to the core CPI. Okay. The red line, core PCE, is more stable than the blue line, core CPI. Right. And since 2004, the Fed has used core PCE, that is the PCE without food and energy. The core PCE is more stable, and the Fed is using this now when they look at various factors in their decision-making process. This concludes this segment.